In this week's update, how much danger is there in the Australian market? Are you confident that the Iran war will be over quickly? And many parts of our economy look stable until they aren't. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. I'm going to start a little differently this week because it's really important, and there's going to be some follow-on to this as well. But I guess everyone's heard the term through their lifetime that Australia is the lucky country. Well, let's unpack that a little bit, because we are now terribly vulnerable. So how did we become so vulnerable to things that happen overseas? Now, admittedly, this energy shock, which started with the Iran war, is probably the most severe one in history. And there's really no end in sight. But I don't think anyone's got any idea how and when this finishes. And it may just be starting for us, the impacts, even if it gets wound up fairly quickly, because we're so much more vulnerable than many other countries. And so the concept of a country that has restrictions on power, has restrictions on food, restrictions on travel, would have been considered just alarmism, pie in the sky kind of stuff that just doesn't happen in Australia. We're the lucky country. But it's now moved from being just an abstract, alarmist concept to it's now real. And everybody can see it in everyday life. And as I said, you'd be a very brave person to claim that this will just blow over as normal and everything will go back to the way it was. That's a very brave call. Now, if you look big picture, the point of this is how it impacts investors. So this is not a political rant on my part. There is a point to this, and it's absolutely about the impact on investors. So if we look at energy, Australia is a net exporter of energy, but it's a fuel importer, and we're highly dependent fuel importer. Does that make sense to anybody? We're sitting on all these energy resources, and yet we're a net fuel importer. It's crazy. If we look at manufacturing, over at least 5 decades that I can recall, there has been a very short-sighted preparedness to allow our manufacturing capacity to go overseas, to be exported. And we're paying the price. And the reason that it's happened is because Australia has progressively become a place where you don't want to invest. It's almost uninvestable because of the cost structure. And even our own companies like BHP are now taking money, substantial amounts of money that would have been sunk into South Australia, into the Olympic Dam project, and that's now being invested in South America. And I could roll out 20 examples. So it's really quite a dire, big picture position. And if anyone wants to stick their head in the sand and ignore it, well, that's just more of what we've been doing for the last 5 decades. So essentially where we sit now, and I hope that this event with the Iran war and the disruption to energy security is the catalyst needed for the majority of Australians to realise that we need to rebuild our sovereign capability, and we need to do it fast, really fast. It's really important. And we're talking about, obviously, fuels. We're talking about energy storage, manufacturing. That's going to be such a difficult one because we've just become so cost prohibitive to do business here. And of course, electrification, where we aspire to lead the world. But how can you aspire to lead the world when your cost structure is uninvestable? There's a real contradiction there for me. So otherwise, if we don't rebuild this sovereign capability quickly, then I really don't know what the journey's like. And for people that have listened to me, I've been doing this for 17 years, for people that have listened to me regularly, you know that my base position is glass half full or bullish where it can be justified. That's my basic disposition. So to call this out, I hate doing this, pointing out where Australia is deficient. But that's the reality. So let me ask you this. Who thinks that we will never see another shipping lane closed or oil field disrupted in some game of geopolitics, whether it involves the Middle East or China or wherever it might be. Who thinks that will never happen again? And who knows, maybe the next one will be even worse. And we haven't seen the impacts of this one play out yet by any stretch of the imagination. So again, the question is that a risk that we should take because we're complacent? And let's face it, that is the problem. Yeah, the politicians have been asleep at the wheel for 20, 30 years, politicians of all persuasion, but we allow them to be through our complacency. And we allow special interest groups to drive the country. Activists dictate policy. Is that what we want? I think it's pretty clear that we as a country need to wake up, and as investors, we need to be mindful of where we sit. You can't just blindly go on investing in Australia like it's the best and only place in the world to invest, because you're going to pay the price. So let's put a positive slant on it. So again, let me put my rose-coloured glasses on and put the most positive slant on this that I can realistically generate. Where we sit right now, and nobody knows how the future's going to look, but I can tell you that the impacts on this country are not suddenly going to go back to normal if the war in Iran was stopped tomorrow. So the best spin you can put on this is that we've got managed strain. We don't have an imminent national shortage of fuel. Whether the government is really telling us the full story or not, with all of the risks, I don't know. I don't know if anyone else knows either, but that's what we've got. We've got managed strain. We've also got practical levers that can still be pulled, and some of those levers have been pulled in the last week with additional cargoes, but they do come with much higher pricing because there's a war premium in that pricing. But there are still practical levers that haven't been pulled yet that could be, but you may not like them. They could be fuel restrictions, odds and evens at the Bowser, lack of food on the shelves. They may not be levers that you are comfortable allowing to be pulled. Now, again, looking at it from a glass half full perspective, part of what we've got at the moment is a distribution problem. We just don't have enough fuel getting to all the places that it needs to go, so it's partly a distribution problem. But this could be still early days, and this distribution only problem becomes a much more severe problem. We're not out of fuel, but I think it's fair to say that we're structurally exposed. So structurally means years and years, decades, things that are difficult, really difficult to change. We're structurally exposed to external shocks. And here's where the relevance to all of us as investors come in, that those external shocks will materially impact the earnings of operators that are fuel intensive. And in a few days' time, I'm going to be expanding this theme with more detail, more depth, but to keep this in line with the normal Sunday video, which is about the markets and about the way that you should adjust your exposures and actions that you might be able to take. So I'll leave that for a separate one. But there is an enormous amount of the Australian economy that runs on fuel availability and cost. And so there is going to be a material impact to earnings. The reality is that our fuel dependence year by year is rising. It's 79% of our imports. We used to have 8 oil refineries, now we've got 2. I mean, how does that happen? The ACCC have said that diesel sales in 2025 would double petrol sales. So if you're someone that has never bought diesel in your life, like me, then you may not have an understanding of what the proportion is, and that figure surprised me. Mining and agriculture, the absolute staples of our economy and our country, are 90% reliant on diesel. For Australian investors, let me qualify, because I think America is in a very different position. For Australian investors, there is credible earnings risk, even if the war winds up tomorrow. And the Australian market has not universally responded to that earnings risk. The index is not down very much. Now, I know a lot of mining stocks are, particularly development stocks, have been smashed, but it's by no means general. There could be far worse to come for the Australian index. Now, America, by contrast, has moved a long, long way in the last couple of decades in terms of self-sufficiency. And that allows them to control their own future. So investors in America, or Australian investors that invest in American stocks, are not as constrained as we are if we only invest in Australian stocks. You've got far more degrees of freedom. You don't have to worry about whether this company has got fuel availability issues or fuel availability cost. So in America, what will still thrive and survive? Now, I'm not saying that all of these stocks will rebound because it will be a sequential process. The index hits the bottom, but the best sectors start to rebound before that, and they rebound sometimes quite significantly. So putting aside the very immediate short term and just look at the long-term drivers and the structural position of the economy, AI and tech is just a mind-boggling array of opportunities that used to be expensive, and now it's a lot cheaper. Are we at the bottom? Not sure, but I know what it looks like when it turns. Infrastructure in America has extraordinary opportunities, and we're seeing that in price trends. This is not something that might happen in the future. The price trends in some industrial stocks will blow your socks off. They're incredible to the upside. They've not missed a beat through this whole war scenario. Minerals. Some have been affected, some haven't, but there is obviously going to be a very, very significant rebound across critical minerals, precious metals, copper, you name it, the whole sector. All the strategic metals that are required. If you look at medical technology, it doesn't get a lot of airplay in Australia, but there is some fantastic stories in America and price trends to go with it. Price trends that are still going through the roof. Just, what war? Completely ignored it. And of course, also in industrial, there's just so many opportunities in US industrial. And finally, the one that kind of really surprises me is consumer discretionary. I mean, American economy's got problems, haven't they? That's what the media tells us. But let me show you a couple of charts in consumer discretionary land in America. Okay, so this is, and I don't know hardly anything about these companies. This is just a representation. This is not a recommendation. This is a representation of what is happening in America. This is a company called Ross Stores. Now, that's a pretty handy trend. Here's where the Iran war started, just there. Look what it's done. Almost no reaction at all. What about this one? Casey General Stores. So obviously there are parts of the US consumer discretionary market that are just carrying on like there isn't a war at all, or there isn't the risk of a global recession. So you just got to be careful what you swallow from the media as being fact. Just look at what is happening on the ground. So it raises the question for Australian investors, should you have US market exposure? Not only because the US market has sectors and stocks that we just don't have, that are in fantastic megatrends, but also because so much of the Australian economy and therefore the stock market is going to be impacted by the position that we find ourselves in. So how to think about stocks. So let's get back to what this Sunday video is always about. But I felt that it was absolutely mandatory to do some kind of wake-up call because of what I read in the media, or what I don't read in the media. What I don't read in the media is the seriousness of the problem that we find ourselves in. So anyway, how to think about stocks. In the Insiders Club, we've been progressively moving towards reducing exposure to anything that has got risk and raising exposure to the parts that should be largely immune. Now, in the very short term, the market can treat stocks irrationally, but in the longer term, the immune bit really does come into play. So the stance that I'm taking, and I've been taking with members for the last at least 3 weeks, is to assume that most of the Australian market will be impacted by where we find ourselves. I think that is a prudent and sensible starting point. And I'm really encouraging everybody to prepare now, because when the impacts start to show in the results and in the activities in the economy, it could get very, very nasty very quickly. If you're not prepared, I'm not saying you necessarily need to do stuff today, but you need to have awareness and you need to have examined your portfolio to see what is immune and what is not immune. And as I said earlier, there will be more detail on this, hopefully in the next 3 or 4 days, so that you can get that sense. But you need to prepare now. You don't want to wait until the stock that you own falls 20%, because your first reaction then is shock horror, and you will almost certainly react emotionally. Do the thinking preparation now. Know what it is that's exposed and what you're going to do about it. Are you going to reduce exposure, or are you going to eliminate exposure? This is my starting point. Every Australian listed company is guilty until proven innocent. That's my base position. So the company that I want to invest in now has to prove that it's essentially immune from these fuel cost impacts and fuel availability impacts. And they're out there. We've been buying them in the last week or two. So find those stocks that have got good immunity to fuel cost and fuel availability and recession, because recession is no longer an abstract concept for the Australian market. It gets treated with complacency because we seem to keep dodging it. And we've been dodging it for 30 years. And it's beyond me as to how we've managed to do that. And it's probably down to our minerals industry. Our minerals export industry has kept us afloat. So find those stocks that have got good immunity to fuel and recession. And Insiders Club members will and are knowing that basically exactly as they become evident to me. So what are the actions that arise out of this? You need to think about whether you should reduce exposure. Now, some people might overreact to that and say, well, if things are as dire as you say, then why not just sell everything and see how it plays out? Well, the problem with that is that, let's say the Iran war was finished in the week coming. There would be a rally, whether it's justified or not, there would be a rally in global markets that'll rip your face off. So to sell everything, history shows, is a backward step. Almost certainly you'll end up worse off if you sell everything, because you cannot, psychologically, you cannot get back into the market as soon as you need to, because you've sold everything and it's that much harder to get back in. So I think it's a matter of reducing exposure to create some cash. But what we're talking about doing here is really more of a strategic attack capital. We're not doing this so much for defensive reasons. We're doing it for offensive reasons, because there are stocks and sectors out there that are immune or largely immune. So that's really all that we're buying at the moment, stocks that have got a high level of immunity. And they include royalty stocks, which I've talked about a few weeks ago. They include software stocks. Software stocks are starting to look like they're forming a base, but they're not really flashing the signal yet that I need to see. Defense stocks is pretty obvious. And also maybe lithium. Now, lithium, I'm a little sort of cautious on. The charts look great. But lithium miners are exposed to diesel availability and cost. So I'm kind of a little softer on that one. So that's in Australia. But in America, wow, as I covered a few slides back, the opportunities are across far broader cross-section of the economy. All right, as I say every week, and as I've been saying particularly since the start of March, this is a time where you can't just wander in with a blindfold on into the market and expect to do well. You are almost certainly going to get chopped up. So you need to get all the advice that you can, obviously advice about the market and the opportunities. I would have to place right at the top of the tree, but then I'm biased, I guess. But you certainly need to get all the other investment advice, the financial advice and whatever. Let's look at American stocks. The S&P had a really strong finish, up 3.4%. There was a bit of a wobble when the market opened on Thursday morning in America, gapped down significantly on the revulsion of Trump's address to the nation. But you saw what happened. There was panic in the market on Thursday morning, and the professionals stepped into the market and they bought and they bought and they closed it almost on its highs. So the S&P up 3.4% for the week, the Nasdaq up 4.4%, and the Russell 2000 was up 3.3%. A very positive finish to the week. So to steal a line from AFL 360, is the bounce real or overreaction? And I try and keep a really open mind on this. And one of the ways I keep a really open mind is that I've spoken about this before, is that for months now, I've been, in fact, for more than that, for a long, long time, I've been keeping two watch lists in America. One is for stocks that are in a strong uptrend, and one is for stocks that are in a strong downtrend. And there is a minimum of 100 to 150 stocks in each. So they're nothing to do with sectors. They're just what's in uptrend, what's in downtrend. And when you do that, you get a very clear view of what the market is actually doing when you go through 150 stocks. Now, last week, I kind of rang the bell a little bit because the stocks that had had extraordinarily strong uptrends for the last 1-2 years definitely showed some signs of rolling over. But I can tell you in the last week that has been arrested. It was a very, very short-term impact. And those stocks started to look like they're getting back on track, and it's just more of a consolidation than a pullback. And equally, the stocks that have been trending down for a long period of time hardly showed any bounce at all. So I'm not seeing a great deal of change. We've got this massive, diverse spread of outcomes and trends in the American market. So you cannot talk about the US market as doing this or that because it's irrelevant. If you're just looking at the index, it's completely irrelevant because you've got stocks that have dropped 50, 60, 80%, and you've got stocks that have gone up 300%. You can't talk about them as a generalization. So the former strongest trends appear to be stabilizing. There was a bit of a lack of commitment in terms of volume. So I'm wanting to see some volume kick back in, but at least they're stabilizing. So that's, for me, that's a point in favor of the bounce being real. The pros buying the intraday panic, that's a tick for the bounce being real. And we've seen this through all the events, 2008, 2011, COVID, just every panic is the same. The retail public panics, the price gaps down on the open, and then it trades up for the rest of the day. Whether it finishes in the positive or not is not the point. The point is that the professionals who close the market have a much better idea and a much better track record. And they are buying those opening dips. There's no question about it. So that's a tick in favour of the bounce being real. However, I've also read, again with an open mind, I've read some very plausible reasons why the US market could go into a significant correction. But that's based on theories or abstract concepts. I'm just not seeing it in a significant part of the US market. Now, the dollar is still hanging around about the 100 mark, hardly moved during the week. The 10-year yield came off a little bit with a more positive environment that the war could be over soon. So the yield came down from 4.4 to 4.3, and the VIX dropped from 30 down to 23. So that's where we sit with the US market. Let's go and look at a few charts. So we'll start with the Nasdaq Composite. So we've broken important support on the NASDAQ. But again, you've got to remember that the NASDAQ is a very large, very general index and includes software that's been absolutely smashed because of fears about AI. So I'm not looking at that and saying, oh, we've just got to desert the NASDAQ. It's fallen sharply, broken key support, but it's rallied back to it as well. And you can see Tuesday was very positive. Wednesday was a gap up. Thursday was a gap down sharply on the open, but then very positive finish. If we look at some of the spreads, this is NASDAQ versus the S&P. You can think of it as growth over value in one sense, and it's stabilised. Consumer discretionary versus consumer staples was falling, but it's stabilised, helped by those charts that I showed you at the beginning of some of the American discretionary companies. This is SMH. Semiconductors, really important to the American economy, really important to the American market. Same deal there with SMH. If we look at it on a relative comparison basis, no surprises, energy at the top, their materials, which is obviously treated very differently in America because their materials sector is not subject to this fuel availability and fuel cost issue. Then we've got consumer staples in the middle. And then we've got industrials. And then everything else below the actual S&P itself. Finance right down the bottom. So it's quite a different market to the Australian market. And if we look at Australia, it's pretty similar. Energy, materials, and then we filter down the line. But our worst sectors, obviously, information technology and healthcare and small caps. So that's where the issues are in Australia. There's the S&P on a weekly chart. So it looks very similar. We've broken important support, and then we've managed to scramble back above it. And IWM also down a little bit further, but looking quite positive. So if we turn then to Australian stocks, our dollar finished at 68.39, and we're just kind of tracking in normal response to what the US dollar's doing. Our index was up 0.75% for the week, but it was hardly convincing, either at the index level or at the individual stock level either. So it appears to me that everything but energy in Australia is pretty much stuck or it's getting pounded, one of the two. We'll just have a quick look at the currencies. So DXY for the US dollar index, and you can see that we're just continuing to consolidate and coil below this really important 100.5 level. If the war gets worse, or the implications of the war get worse, then expect to see the US dollar break this level to the upside, and that will keep pressure on commodity prices. If the war comes to some kind of ending, with either side claiming victory, then we'll probably see the US dollar fall and fall quite quickly. And commodities, that'll be the rip your face off rally in commodities. So that's why you can't afford, in my view, to sell everything, particularly in commodities, because you'll just never get back in at a price that is at all acceptable. And the Australian dollar, of course, just following suit in the inverse direction. Precious metals, gold was up 4% for the week to 46.77 or 67.70 in Australian dollars. Silver didn't move a great deal. 73 is where we finished. Gold stocks, now GDX, which represents all the overseas and local major miners, it's just listed here in Australia, was up 1.4% for the week. But North American miners are outperforming the Australian miners by a significant degree. So let's go and look at silver and gold. We'll start with silver. This is a daily chart. So we're certainly, after this amazing blow-off that we got at the end of January, we've dropped from around 120 down to 70, the low 70s, even dipped almost down to 60. So we've had a 50% retracement from the top. But the long-term outlook for silver still looks amazing, but it's the timing of it that is the issue. But holding some exposure to silver can certainly be justified. And I said last week that we were in a position where it kind of felt like the calm before the storm. Which way would it go? We broke out to the upside, but then Thursday was a bit of a pullback the other way. So it's still quite uncertain. And I wouldn't put my hand on my heart and profess to know which way that's going to go. And that's where we stand in Australian dollars. And I'll just quickly go and look at GDX. So there's GDX and GDXJ for last week. So turning to other commodities now, copper was a little bit higher, $5.56. Crude oil shot up, and I said last week that we were poised for an explosive move one way. I just didn't know which way it was. It's gone to the upside by about $10. So what we've got here is the repricing of crude oil because of supply risk. And if supply risk gets larger and larger, then projections that oil could hit $200 a barrel are not unrealistic. But this is not obviously a demand-driven rally, so it's about supply risk. And there is an incredibly wide divergence of views on this. So I would find it very difficult. I've got some energy exposure in America, not a great deal, and it's more of a hedge. It's to be in a market that has got upward momentum. So for me, it's really more of a hedging exercise. So that's where commodities sit. There's copper up a little bit on the week. There's crude oil with a big breakout. So wrapping it up, and I know this video's been a bit long, but I just think it's just such an important subject because it's not going to go back to being business as usual in Australia. So the final message is, I don't see need for drastic selling where you sold 70 or 80 or 100% of your stocks. We're not in that place yet. But I think it's prudent to assume that we're going to get a bad local market outcome, because I think that is, or not I think, it is obvious that a bad market outcome is more possible than it normally is. This is the most severe energy shock we've ever had, and it's by no means over. It could be just starting. So I think that has to be your base assumption. Review all your current exposures. The type, are they exposed to fuel and fuel costs, and the weighting of them? So you've got to review all that. The new buying opportunities, some of them look very enticing, but the one common trait that they've all got, from my perspective, is that they've all got varying levels of immunity from this whole fuel thing. And again, let me stress, America is different. I view the American market as a much kinder market at the moment for investors. What I'm talking about here is for Australia. But even in America, the wonderful have been discarded with the trash, and now they're cheap. Software is one obvious area, but there are others. So the reward for risk in selected stocks that have that kind of immunity within their own markets have never been better. So that's why it's a little scary at the moment, but it's also very exciting. Because we've now got businesses that have progressed over the last year, 2 years. They've got bigger, they've got better balance sheets. Whichever way you look at it, they're better businesses, but the prices are a lot lower. I mean, how good a combination is that? That's what investors should die for. The final point I want to make before I just cover off on what I'm going to do next week is market consensus is not always wrong at the extremes, but most of the time it is wrong. So you catch yourself wanting to follow market consensus because it feels comfortable, and then don't do it. It's about the best advice I can provide investors at the moment. So this is so important, and maybe some viewers won't be interested in this, which is why I really kept the detail out of it today. But I'm going to be expanding on this in coming days for those who are interested, and specifically looking at how this could hit local stocks by industry. So that'll help you with the contemplation about your type and level of exposure. What investors should watch from here, both fundamentally and technically. So what are the signs to look out for? And what's the real balanced view of our vulnerabilities and our earnings risks? So not glass half full, not glass half empty. Let's just keep it unemotional and balanced. What is the reality? And I can do that, and I've been doing that for 17 years because I don't have a vested interest. My only interest is in presenting the information in the most realistic way that I can. I'll also be looking at whether renewables in Australia can cover the gap. And I think everyone kind of knows the absolute answer to that, but there are lots of varying degrees. And that's important because that's the path that our government has got us on. So what I'm trying to do here is to make sure that investors are informed, because the media just does such a terrible, terrible biased job of keeping us informed accurately. So I'm just doing my little bit to help investors have a more realistic view of what's going on. So that's it for this week. As I said, hopefully there'll be something out during the week. And if not, I'll still be back with you next Sunday. Cheers.